Hi everyone, how are you? It's Leah Koss with the Mortgage Center, and this is such an important presentation for everyone to watch who's looking to buy a home or refinance or anything like that. And I want to talk about debt versus income, and more specifically, how to maximize your buying power. And I'm going to do this in two ways. For one, I really want you to understand that when you get a pre-approval from a bank or a mortgage broker, that pre-approval is not set in stone. The second thing I want you to realize is that there's more than one way to skin a cat. And what I'm going to do in this presentation is show you one scenario of a family, and I'm going to show you how I can do a pre-approval for them in 4 different ways and get 4 completely different answers. All right, so let's get started. Now, for those of you with inquiring minds, I'm sure that you're going to have the first question being, what are these numbers? How did you come to this conclusion, and why should I take my word or take your word for it? And what I'm using is the TDS or debt service ratio calculation. This is the calculation that banks, lenders, mortgage brokers, anyone in the banking industry does in order to qualify you for a mortgage. So I've already done a video on this. If you're curious of the nuts and bolts in the process of coming to these numbers that I'm showing you in this presentation, go to my website, leahkoss.ca, search for TDS or debt service ratio in the search bar there, and it's about 3 videos down. It's a black screened PowerPoint just like this, and it's going to show you that whole equation. If, however, you just want to go straight into the approval process, you can give me a call today for a over-the-phone pre-approval, or you can fill out an online application as well at leahkoss.ca. It's the red button on the right-hand side that says Apply Now, and those are the first steps that we need to do in order to go any further into getting you a mortgage and finding out your different options. But let's jump into this presentation, and I want to talk about debt versus income. Now, in that debt service ratio calculation, the TDS calculation, as you can imagine, debt and income are the 2 biggest components of that calculation. But it's very important for you to understand that income in this equation is fixed. And the reason it's fixed is the banks don't care about the here and now. They don't care about your income this year or next year. They care about your last 2 years. And because of that, there's nothing you can do today to change that income. Therefore, income is not something we can play around with. However, debt is. Debt is the variable in this equation. So by lowering your debt or changing your debts around, we can increase your buying power. The only other ways to increase your buying power on a mortgage application without playing with the debt is by getting a cosigner or a larger down payment. So let's review the actual scenario that we're going to be working with today. This scenario is not going to change. It will remain constant through all of my 4 different examples of pre-approvals. We've got a husband and wife team, and they want to buy a detached home in Coquitlam. The husband makes $50,000 a year and the wife makes $30,000, and we're going to assume that they both have good credit. We're also going to assume that they have $30,000 just for the down payment. We'll assume that they have a separate bundle of money for their closing costs. Now, if you are at home doing these calculations on your own, the other variable that you need to know is that I'm assuming that the property taxes based on a single detached home in Coquitlam is $2,500, and that's the other part that's going into this equation. But for the majority of you, you don't need to worry about that. Now that's just one side of the equation. Obviously the other side is the debts. So the scenario that I've laid out is that the husband's debts are 2 credit cards and a car payment. The wife's debts are a credit card, a student loan, and a car. And they have a joint line of credit. Now don't worry about memorizing these debts. You're going to see this slide another 4 times in this presentation, but I just wanted to lay out the scenario for you so you knew what numbers we were working with, and that it is a fairly reasonable scenario. There's many families out there with credit card debts and car loans and student loans, so this is very reasonable. So example number 1, obviously I need to set some sort of baseline. So I'm going to do an as-is pre-qualification. If this family were to walk into a bank or go to a mortgage broker today with those numbers, this is what they would qualify for. So in this scenario, nothing is paid down. They're both going to be on the mortgage, and the next 3 criteria are going to remain constant through the rest of my scenarios. We're going to do a 35-year amortization. We're going to include mortgage insurance of CMHC or Genworth, and we're also going to include 4% for the actual fixed interest rate. Now, with their $30,000 down payment, they could afford a $291,000 home. That is their baseline. So this is what we're going to refer back to when we're looking at the other scenarios. Now, the first thing I would do with this family, though, if that wasn't enough, maybe they wanted to buy a more expensive home, the first thing I would look at is their line of credit. And I'd ask them, do you have any more room on your line of credit? Can we move any of your debt over there? Because if you look at the line of credit, they owe $10,000 and only have to pay $100 a month for it. But with $5,000, half the amount of debt on this husband's credit card, he owes 50% more a month. $150. So simply by moving that credit card debt of $5,000 over to the line of credit, we're now giving them a cash flow advantage of $100 a month. So that's what we're going to assume that we can do in this first scenario. We're going to move balances around. By doing that, we get to use $100 more for their mortgage payments. Everything else remains the same. And now with their $30,000 down payment, they can afford $313,000 home. That's a difference of $22,000. That's a significant quality of home difference. Depending on, in Coquitlam where they're looking, $22,000 will make a huge difference for them in the quality of home that they're able to purchase. So that's the first example, and that's a very common thing that we're able to do simply to maximize your buying power. But that's not all. The next scenario is actually a scenario I would not recommend for this particular couple, but it is a scenario that I recommend for many of you out there. And that's where we're going to separate the husband's debts and income from the wife's debts and income. We're going to qualify them as two separate individuals. Now, it's important to know that the joint debt, although it's in both of their names, we have to qualify the husband separately with the joint debt. If we qualify the wife separately, we also have to include the joint debt. Okay, because it's in their names. Now again, I don't recommend this with this particular scenario because right away I can look and see that going from $80,000 of income down to only $50,000 or $30,000, not going to be beneficial for this couple. But here's a situation where it is. If you have one sole income earner or someone who makes a majority of the income and the other person doesn't, and where this is common is if, say, the husband is the sole income earner, the wife is in school, she probably has credit card debt and student loan, that's debt. Okay, and because of that debt and her not contributing any income or any significant income, maybe she's got a part-time job that's contributing, $10,000 or $12,000 a year, she's actually hurting the application as opposed to helping it. So in that situation, we would remove her and just have the husband on the mortgage application, and that's going to significantly strengthen them. But like I said, this is not the best scenario for this particular couple, but let's run through it anyway just to show you. So by removing a spouse and leaving the debts alone, the husband with the $30,000 down payment could afford $176,000 and the wife could afford basically $70,000 of a home on her own. So not the greatest scenario for this couple, but definitely an option for you to look at in your own situation. Now the last scenario, the last example that I want to go through with you is the example that I would recommend for this couple. Now, as we've been talking about, they have $30,000 of a down payment. They don't need that full $30,000 in order to have 5% down for their home. So what I would recommend for them is to take $8,000 and pay off two credit cards, specifically the $5,000 and the $3,000 credit card. That has now given us a cash flow of $240 more a month that can go towards the mortgage in the calculation. And now, with all other things remaining the same, they can qualify with a $22,000 down payment for a $336,000 home. That's a difference of $45,000 compared to the as-is baseline qualification that I did in the example number 1. That's a significant difference. Imagine walking into your bank, getting pre-qualified, but not realizing that you're leaving $45,000 on the table just by doing something that's well within your means. It's not mortgage fraud, it's just you paying down debt. And now you're able to afford a much nicer quality home for yourself and your family. So those are the 4 examples that I wanted to run through with you today. Those are not the only examples. There's many ways of changing your debts around and helping to increase and maximize your buying power. But that, I just wanted to show you to get your mind working, to help you realize that a pre-approval is not set in stone, and to ask questions of whoever's doing your pre-approval. What criteria are they using? So if you want to get started today and get into finding out what your options are based on your debts and your different down payment scenarios, then fill out an online application with me today. You can do that right online. It only takes about 5 or 7 minutes to do. It's at leahcost.ca, the red button on the right-hand side that says Apply Now. Click on that. It'll take you straight to the application. Again, I am Leah Koss with the Mortgage Center. I'm an independent mortgage broker. I'm not affiliated with any one bank. I'm always happy to help, and hopefully I'll be able to talk to you soon. Thanks so much for listening.